Back in 2008, banks nearly broke the global economy. So regulators did exactly what you'd expect. They stepped in and made it significantly harder for banks to just lend money out. Boom, problem solved, right? Well, not exactly. Actually, scratch that, because what happened next is honestly one of the most fascinating unintended consequences in modern finance. By putting traditional banks on a tight leash, regulators accidentally greenlight a massive, sprawling shadow banking system, and it operates almost entirely outside the banking system we all know. It's kind of like a task failed successfully situation, right? Most folks have never even heard of it, yet it is fundamentally rewiring our global economy. Welcome to our explainer on the absolute biggest financial story that Wall Street is definitely not putting on billboards. Okay, let's dive into this mind-boggling number right here. $1.7 trillion. Literally, $1.7 trillion. That is the sheer size of the market we are talking about today. And it's a market that is quietly financing almost everything around us. From those mid-sized manufacturing plants pumping out the stuff you buy every day, all the way to the cutting-edge data centers fueling the whole AI boom. This shadow market is the one supplying the capital. It's this absolute ocean of money flowing completely under the radar of both regulators and the general public. So this begs a really obvious question. When regulators cracked down post-2008 and made it way too expensive and heavily penalized for traditional banks to loan money to a lot of businesses, those businesses didn't just magically stop needing cash. They still had to build factories, hire people, and grow their operations. So who exactly stepped in to fill that enormous void? Who took over the steering wheel when the banks were forced into the backseat?
Section 1, the new shadow bank, rewiring corporate finance.
To really get this, we have to decode how the entire system of corporate finance got completely rewired. See, for decades, if a company needed to borrow a substantial amount of money, they really only had two classic paths. They could either walk into a bank and get a loan, or they could issue bonds on the public market. But now we have this wild third path, private credit. Let's translate some of this Wall Street jargon into plain English. Instead of dealing with a bank or a public market, a company goes and borrows directly from a private fund. And here is the absolutely crucial point. There is zero public market for this debt. There's no daily trading. There is no stock ticker you can just look up on your phone. It is simply a highly structured, totally private loan negotiated between a company and a lender. And that lender, they usually just plan to sit on that loan until it is completely paid back. Now, if you're sitting there thinking, this sounds like some tiny niche market, check this out. 5 years ago, in 2020, this market was sitting at around $500 billion, which is big, sure. But today, it has exploded to over $1.7 trillion. And looking ahead, industry forecasts predicts this market is going to approach a staggering $4 trillion by 2030. To put that into perspective, the explosive growth is so intense that the Federal Reserve actually looks at this private credit market and considers it roughly comparable in size to the entire market for traditional bank loans and corporate bonds combined. Worlds that used to be totally separate are now neck and neck, and one of them barely even existed in any meaningful way 20 years ago. And honestly, the ceiling for that growth, it might be way higher than anyone even realizes. $41 trillion. Some recent estimates put the total addressable market, which basically means every single dollar of credit that private lenders could theoretically compete to finance, at over $41 trillion. So the narrative for this explainer totally shifts here. We don't need to ask, is this market big anymore? We know it's massive. The real question we need to answer is, why on earth did this happen? Section 2, why banks stopped lending. To understand why traditional banks deliberately just walked away from all this business, we gotta look at the history. And this brilliantly illustrates how regulation directly birthed the private credit boom. It all starts back in 2008 with the global financial crisis. In the fallout, a set of rules, specifically Basel III and the Basel III endgame, forced banks to keep a lot more capital in reserve against any risky loans. Suddenly, lending money to a mid-sized company that wasn't strictly investment grade became incredibly expensive for traditional banks. So all through the 2010s, banks got picky. They pulled way back from that riskier middle market. But that left a huge gap in the economy. And stepping right into that gap were private credit funds run by massive Wall Street firms you've likely heard of. Blackstone, Apollo, Ares, and KKR. They literally just swallowed up the exact role the banks left behind. But here is the ironic twist that I just find absolutely fascinating. It isn't some bitter rivalry between the banks and these private funds anymore. Nope. In fact, banks and private credit funds are now quietly partnering up.
A growing number of traditional banks are actually originating these loans and then turning right around and selling pieces of them back to the private lenders. Why? To earn the fees, of course. So the banks that were effectively shoved out the front door by regulators are quietly walking right back in through the side door and charging a cover fee while they do it.
Section 3. Funding the AI boom.
So where is all this actual cash coming from today? Like, who was writing these giant checks? While everyday investors are just starting to dip their toes in, the bulk of the money is coming from massive institutional heavyweights. We're talking pension funds and giant insurance companies, specifically life insurers. But why are they dumping billions into this? Simple. Life insurers desperately need steady, reliable contractual returns to match the long-term payouts they owe to their policyholders. They want absolutely nothing to do with the crazy volatility of the stock market. Private credit gives them exactly that steady stream of predictable income they need.
And where is that money going? Right now, it is literally fueling the future. Private credit could end up supplying more than half of the $1.5 trillion needed globally to build out artificial intelligence data centers through 2028. Just think about that for a second. This incredible AI boom we are living through right now, the advanced chips, the massive computing power, the giant warehouses packed with server racks. A huge chunk of that is being financed, not by public stock markets, but by this invisible private lending system. This capital is quite literally laying the physical bricks and servers of the AI revolution.
Section 4. Main Street joins in.
Now, this previously exclusive institutional VIP club is finally opening its doors to everyday people. But how exactly do regular folks get in on this? Well, it's through something called interval funds. Let me translate this into strict plain English for you. Up until recently, you had to be a huge pension fund or a massive institution to invest in private credit. Now, they've created these semi-liquid retail funds that you can buy right inside your standard brokerage account. They call them interval funds because they strictly limit how often you can actually take your cash out, sometimes just once a quarter. But in exchange for locking your money up for a bit, they let everyday retail investors buy a slice of these privately negotiated corporate loans.
And let me tell you, retail investors are flocking to this. Retail exposure to private credit has absolutely skyrocketed by more than 75% in just a few short years, hitting roughly $450 billion today. That means everyday people, honestly, maybe even some of you watching this explainer right now, are directly exposed to loans given to companies you have literally never heard of. And because these are private, backroom deals, they come with way less transparency than if you just bought a standard mutual fund or stock.
Section 5. Warning signs and cracks. Okay, so when any market grows this fast, with this much opacity, things start to get complicated. And late in 2023, we saw two huge borrowers just completely collapse. One was Tricolor, a subprime auto lender out in Texas that allegedly pledged the exact same car loans as collateral multiple times over. Yikes. The other was First Brands, the company behind really familiar auto parts like Fram and Prestone. They filed for bankruptcy after investigators uncovered billions in hidden off-balance sheet financing. Now, what's really interesting about these numbers is the massive gap between perception and reality. Lenders thought they were lending to a company borrowing at maybe 5 times its earnings, but the actual terrifying reality discovered in bankruptcy court, it was closer to 20 times. And it wasn't just tiny lenders left holding the bag here. Major global players took a hit. UBS disclosed over $500 million in exposure, and Jefferies flagged over $700 million tied directly to these blowups. This whole mess prompted Jamie Dimon, the CEO of JP Morgan, to issue a shockingly blunt warning. He said, "When you see one cockroach, there are probably more." The real gravity of that quote isn't just about Tricolor or First Brands failing. It is about systemic risk. It's the terrifying unknown of what else might be lurking in the dark corners of a $1.7 trillion market, a market built almost entirely on privately negotiated deals with incredibly limited public disclosure requirements. And because of that, market analysts are staring unblinkingly at one specific flashing red warning sign right now, the sudden spike in payment in kind or PIK loans. So what is a PIK loan? It's a setup where a borrower, instead of paying their monthly interest with actual cash, just pays it by piling on even more debt. It is quite literally the corporate equivalent of paying off your credit card with another credit card. The use of these PIK loans has shot up sharply since 2021. For the analysts watching this space, this is a classic, undeniable signal that these borrowers are under severe, quiet financial strain right behind those closed doors. And that brings us to the absolute core systemic vulnerability of this entire shadow banking system. Private credit is a massive, critically important market, but it has never actually been tested by a real, punishing recession. It basically grew up entirely during a decade-long era of easy money, rock-bottom interest rates, and historically low default rates. So, Tricolor and First Brands, they might just be the opening act. The next true economic stress test is going to be the main event, and it will ultimately decide if private credit becomes a permanent, resilient pillar of global finance, or just the subject of the next major How Did We Not See This Coming documentary.
So, as we wrap up this explainer, I want to leave you with one very direct question. Knowing that this shadow market is literally funding the future of AI, but also knowing the hidden leverage, the cockroaches, and the total lack of transparency involved, would you put your own money into a private credit fund? It is a wildly fascinating evolution of finance, and for sure, it's something we all need to be keeping a very close eye on. Let me know your thoughts on this down in the comments below, and as always, keep actively questioning the systems shaping our economy.